All right, in this video, I'm going to talk a little bit about some of the different theories of capital structure. And again, structure is just looking at the different combination of debt, preferred stock, and common equity. So the first one I'm going to talk about is trade-off theory. For trade-off theory, there is an ideal capital structure. So if you are seeing a reference to an ideal mixture or an ideal level of debt or something like that, they're pretty much we're talking trade-off theory. And the idea behind trade-off theory is that there is an ideal capital structure that's a trade-off between the benefits of debt, basically a tax break and some financial leverage. And I'll come back to that in a minute. And the risks of debt, the possibility of going bankrupt or just financial distress risks. So basically what happens is when you take on $1 of debt, you incur interest. And when you incur interest, every dollar that you pay in interest reduces your taxable income. And when it reduces your taxable income, then it winds up reducing how much you pay to the government. And as a result of that, it doesn't feel as expensive. So for instance, if the tax rate was 20%, if I pay $1 in interest, then I now have $1 less of taxable income. And so now I'm going to pay, if my tax rate was 20%, I'm going to pay the federal government 20 cents less. So I paid $1 in interest, but now I don't pay 20 cents of taxes on that dollar. And so the net effect is kind of feels like it cost me about 80 cents in my example. So we get a tax break on debt. I do not get a tax break on what I pay to my investors who invested by buying shares of stock. I do not get a tax break on what I pay my preferred shareholders. So I get a tax break from the standpoint of debt, though. So taking on debt is kind of attractive in the sense that I do get a tax break on that. And there's a financial leverage effect. So here's the basic idea behind the financial leverage effect. If I borrow $1 at, say, 8%, and I invest it as a company in investments getting, say, 12%, well, where does the extra 4% go? Because I have to pay 8% to my lender. Where does the extra 4 go? Well, the answer is the extra 4% is going to go to your shareholder. So the shareholder is going to get money that's being generated from money he didn't even put up. And so basically that's a financial leverage effect where the shareholder is making money off of the borrowed money. Now, if you're thinking, well, that sounds kind of too good to be true, the answer is it kind of is. There's a catch. And the catch is if you borrow at 8% and you invest and let's say you only get 2% this year, you still have to pay 8%. So where does that extra 6% come from? Well, basically it comes out of the shareholder's share. And so now the shareholder basically through losing returns or shrinking of his investment basically has to make up the shortfall. And so now, in effect, the shareholder is losing money on money the shareholder didn't even put up. So it can make the shareholders' returns much worse or much better with borrowed money. But that's a topic I'll discuss more with financial leverage specifically. But basically what that means is when I borrow money, I get a tax break, I get a leverage effect. Both of these can be kind of advantageous potentially. However, when I borrow money, there are risks. And with the risks, basically we have, the more debt I take on, the more probability there is that I'm going to go bankrupt. And that means if I go bankrupt, well, my shareholders might walk away with nothing, particularly depending on how much debt I have. And I don't even necessarily have to go bankrupt. If I just have enough debt that I get my company into a sticky spot and it's tricky to try to figure out how to get out of this. So if it's tricky, or kind of I'm kind of stuck there, so hence kind of a sticky spot, then basically that's where the financial distress risks can come in, where it can be difficult for my business to move forward. Maybe I have to go through layoffs and shrink the company, and et cetera, to survive. Basically, because I had a bunch of borrowed money, and it put me in that difficult position. So basically, I'm looking at the benefits of the debt with the disadvantages of the debt, and the trade-off theory is basically saying I'm looking at the benefits of the debt and the trade-offs of the debt, and I'm sort of trading them off. So when the benefits of $1 of debt exceed the disadvantages or risks of the debt, I take on the debt. And I'm going to keep taking on debt as long as the benefits associated with the debt exceed the risks or disadvantages associated with the debt. Now, eventually, as I take on more and more and more and more debt, the risks are going to be rising relative to the benefits. And I'm eventually going to hit a point at which if I take on more debt, the risks will rise more than the increase in the benefits or expected increase in return. And then basically that's not a good situation. I should stop taking on debt at that point. So basically I'm going to take on as much debt as I can up until the disadvantages outweigh the benefits. And that's the idea behind trade-off. I'm trading off the advantages and disadvantages of that. Now, to kind of see that, I'm going to sort of jump ahead here a little bit, and I'm going to show you this graph. And basically what's happening with this graph is essentially if I start off with full equity and I'm looking at my overall cost of capital, this is a weighted average cost of capital, which I'll discuss more in a subsequent video. But basically what happens is as I take on progressively more debt, so by the time I move over to here, I'm just completely financed by debt. Basically what happens is I'm getting progressively more risky as I take on more debt. Now, if I'm full equity, my shareholder might expect some rate of return up here. My lender, if I take on $1 of debt, my lender may want a return that's just down here. Because from the lender's perspective, if this is the only dollar of debt I have as a company, this is really high probability the lender's going to get their money back. Because even if the company went completely bankrupt, but if they've got billions of dollars of assets and only $1 of debt, pretty much the lender's like, I'm going to get my money back, right? So the borrowing cost would be pretty low. But what would start to happen is as I take on progressively more debt, well, the risk that's occurring for the shareholder is going to be going up. So this is going to start to climb. So it's gradually going up. And the cost for the lender is gradually going up. And basically, this line here is showing what happens for the weighted average between the two. So as I take on more and more debt, the shareholder requires more, the lender requires more, everybody is requiring more return because everybody's facing more risks as we take on more debt. But the average cost, because I'm averaging the cost the shareholder requires, I'm averaging the cost the lender requires, the average can actually decline. And so I can have a declining average, even though each of the underlying numbers is going up. And so basically behind trade-off, what we're going to do is we're going to keep taking on debt until I basically get to that low point. And once I get past the low point, then basically what's happening is the disadvantages of the debt are outweighing the advantages of the debt. And so it starts to climb. So another way of looking at this is basically this is actually showing why it's better to take on some of that debt, because basically as this line goes down, that's showing sort of in graphical form the extent to which those benefits are outweighing the disadvantages. And it's reflecting that in a lower weighted average cost of capital. Once I get past that low point, wherever it is, once I get past that low point, the disadvantages are outweighing the advantages, and my cost of capital is starting to climb again, and that's not as good. Okay, so back to this. So trade-off theory is basically all about balancing those advantages and disadvantages. Market timing theory. Market timing theory basically says that a firm's capital structure, their mixture of debt, preferred, and common equity, arises from corporate attempts to time the market. And so basically what this would mean is if the company is looking at the stock market and they think, the stock market is really, really, really high. Our company's stock price is really, really, really high. Maybe I ought to sell stock. Because the stock price is really high, so I can sell a comparatively small number of shares and get a whole lot of investment into the company. So I don't give up a lot of ownership in the company, but I do get a lot of capital. So in other words, if I'm a company, it makes sense to sell shares when the price of the share is really high. Okay. So the idea would be if the stock market's high, the company issues shares because basically it looks like a good time to do it. And if the rates are low, so if the borrowing rates are low, we're going to borrow because it's an inexpensive time to borrow money. And so the idea behind market timing theory is basically that the end result of the firm's capital structure is really just sort of, it arises from the company making these decisions year after year to take advantage of or time essentially the market and issue stock when it looks like it makes sense to issue stock, and borrow when borrowing costs are low. And the firm's mixture of debt, equity, and preferred stock basically just sort of pops out of the series of choices the firm has made for that over the years. Now, there's another theory about how firms pick their capital structure, and that's the pecking order theory. So for the pecking order theory, this is kind of like if you have chickens and there's sort of like a hierarchy with chickens, all right? There may be like one chicken that sort of rules the proverbial roost, right? And there's a hierarchy beyond that. So that's kind of the idea behind the pecking order theory here, that basically there's a priority prioritization of these different types of financing. So basically, the firm's capital structure is going to be arise from the result of firms basically following that priority system of getting capital. So let's talk about kind of what a firm would do. So basically, the firm is going to do spontaneous funds first. So if there's some kind of funding that pretty much arises spontaneously, they don't really have to do anything. Hey, we're all in. We're going to do that. So an example of that would be if I'm expanding my business and so I'm selling more product, and therefore I'm buying more product. And if I'm buying more product, I wind up with more accounts payable on my books. Hey, that's a liability. I didn't have to do anything crazy to wind up with this. All I did was run my business. Bingo, I have more liabilities there. I'm growing my balance sheet. So, this is pretty spontaneous. And so that's the idea. We're going to do that. It's super low hanging fruit. All I have to do is run my business and I wind up with basically some debt. It's short term, but I wind up with some debt there. Now, notably in my example, I use accounts payable for a reason. It's basically because I just keep buying from my supplier on a larger volume, though, and I wind up with the accounts payable. What would not be spontaneous funds would be a bank loan, for instance. So for a bank loan, I got to go down there, convince a loan officer to lend me money, and the loan officer may decline. So that would not be a spontaneous source of funds. That's somebody has to agree to it. And if somebody has to agree to it and decide, hey, I'll sign on the dotted line and let you actually borrow the money, then that's not going to be a spontaneous source of funding in this context. Then next down the line, retained earnings. Well, where do retained earnings come from? Well, that's coming from net income that I just don't pay out as a dividend. So basically, if I run my business, I sell my product, I'm making a profit, and then I just don't pay a dividend. Hey, got retained earnings. That's a source of funding. And that would be a source of capital, right? So basically, from a pecking order standpoint, spontaneous funds, then retained earnings good. So for retained earnings, I just don't pay a dividend, right? So if I just don't pay a dividend, I get the retained earnings as long as I'm making money, right? Next down the line, short-term loans. Well, now I am going to the bank, proverbially speaking, and I'm going to try to get somebody to lend me money on a short-term basis. Possibly could be doing some kind of commercial paper or something like that. Generally speaking, probably it'll be easier for me to issue some or borrow on a short-term basis. So issue something kind of short-term like commercial paper or borrow on a short-term basis than it would be for long-term. So I'm gonna do some kind of short-term loan because it's relatively easier. Next step down, long-term loans. Well, that might be a little harder to get somebody to lend me money for, say, 20 years. So that might take a little bit more work to find somebody who's willing to extend that kind of a loan to me. Or maybe I'm working with the financial markets. I'm issuing bonds. I got to find financial institutions to buy the bonds, right? Probably work with investment banks, et cetera. It's a little bit more involved. Then we get all the way down to the bottom of the list here. We got stock, where we're actually selling stock to actually raise capital. This is much more involved. This is a bigger deal. Runs risks of communicating things to the shareholders I don't necessarily want to communicate. Little sidebar. Sometimes companies sell shares of stock when they're in financial distress, for instance. So I got to be careful about how I'm communicating and what I'm communicating. So that's kind of it's hard. It's involved. May not necessarily communicate what I want. So that's kind of the least attractive. So the pecking order theory basically says I'm going to start down the list from the easiest to get to the hardest to get, and I'm just going to work my way down the list. So if I need $20 million, I'll start with spontaneous funds, then I'll go to retained earnings. I'll just work my way down the list until I've gotten I've gotten the full $20 million I needed. Now, within this, probably the bulk of the studies have kind of supported probably more the trade-off theory and the idea that we're trading off the advantages and disadvantages. And that's what leads to the idea of an ideal capital structure, so an ideal mixture of debt and equity. If you're comparing a company's debt level to an industry debt level, for instance, by implication, you're basically embracing the idea of trade-off theory. You're basically saying there is an ideal number. And if you're saying there is an ideal number, that's trade-off theory in this context. Now, having said that, I think there is some evidence to suggest that probably some level of the market timing or pecking order theory is probably true to some extent. So for market timing, there have been some instances where companies have pretty much flat out said, hey, we borrowed because the interest rates were super, super low and we didn't think they're going to be low again for a long time. So we borrowed. And then that'd be more of a market timing kind of a thing. And it certainly looks like companies kind of tend to issue stock near the top, or there are a lot of IPOs. It's hard to tell whether they're timing or whether it's just, the prices look advantageous or they see other companies doing it. It's kind of hard to know what that motivation is there, but it sort of looks like there might be some truth to that. It kind of makes sense that companies might try to do something with that a little bit. It's probably not as supported in the academic research, but kind of makes sense that there might be some nugget of truth in there somewhere. And then for the pecking order theory, I think there's probably some nugget of truth in there too, in the sense that companies probably do, to a certain extent, on a day-to-day basis, use sources of funds that are easiest. And basically they're going to try to avoid getting into the big, more involved things like issuing bonds or stock if they can help it. Now, if the shorter term, easier solutions are much more expensive, that's a whole other story. But if they can avoid getting into really involved things like issuing bonds or stock, oftentimes they probably do. So there's probably a little nugget of truth in there too. But again, most of the studies have really tended to land on the idea of, that trade-off theory probably is what makes the most sense for balancing out those advantages and disadvantages of taking on debt. Now, there are a few additional details that are kind of worth noting. So to kind of set the stage for this, when trying to figure out what's motivating companies to have different mixtures of debt, common equity, and preferred, basically, academic researchers have tried some different things, and they've gone through some different studies to try to figure out, what's driving this. And some of the most famous folks that did this were fellows by the names of Modigliani and Miller. And basically, they started off with a really interesting kind of basic world. Okay, they made a whole slew of assumptions, which I'm not claiming are realistic. Okay, but they help us see something rather important. So the set of assumptions, let's talk about it. If we had no taxes, all right, so no taxes of any sort, we don't have any transaction costs. So basically, you can buy and sell shares of stock with no cost, no transaction cost at all. If stocks and bonds are infinitely divisible, so if you could buy a fraction of a share of stock and a fraction of a bond and things like that, and if all companies have the exact same investment opportunities, and if we have no risk of bankruptcy, and probably throw in a few other no risk of financial distress, all that kind of stuff. Then basically, if you make those assumptions, what Modigliani and Miller were able to show was, turns out when you crunch the numbers, it actually makes no difference what a firm does for its capital structure. It's all the same, basically. It makes absolutely no difference whatsoever. But then they said, all right, well, this is a really unrealistic world, right? So that we've imagined with this. So let's make this a little bit more realistic. So they actually added taxes back into the situation. All right, well, what if we do have taxes and interest on the debt is tax deductible? So what do we do? What happens at that point? Well, if you do that and you make all the other assumptions, but now we have taxes, well, because debt gives you that tax deduction, all of a sudden debt starts to look attractive. And basically what pops out is firms should just finance entirely with debt. And they should use 100% debt. And they shouldn't have any equity at all because basically debt gets us a tax credit, basically, or not a tax credit, but a tax deduction. And so I basically reduce my taxable income. And so this is good. We should do debt. Well, if we make the world a little bit more realistic, we say, okay, so we got taxes, but also if I take on debt, it's possible to go bankrupt or wind up with financial distress. So if I add that situation back in, and I've still got the taxes in there, turns out what pops out is, there is actually an optimal capital structure that minimizes that weighted average cost of capital. And basically what happens is I get that curve on that graph that I showed that basically minimizes the weighted average cost of capital, and that looks like the ideal target spot. And so basically what that's saying is we want to be at that lowest weighted average cost of capital that we can get at, and that's what we're going to target. So with that in mind, basically we're going to look for the low spot. That's pretty much where we're going to go. Now, important to note, the low spot is not always evenly spaced between full debt and full equity. Okay, it could be, the low spot could be over here, it could be over here. All this graph is to denote is that basically the idea that there is a low spot somewhere on this graph. Okay, and the way I've drawn this particular one, it's right around here, right? But the idea would basically be we're going to look for the low spot wherever that is, and that's going to be what we're going to target. Okay. So again, most of the studies tend to support the trade-off kind of approach. There probably is some nugget of truth, though, to that market timing and pecking order kind of theory. There's probably some aspect of that that's probably true to some extent, though. All right, hopefully this little discussion about theories about capital structure and kind of ideal capital structure, some of the theories and things like that has been helpful. Thank you so much for watching, and have a great day.